Hey guys, welcome back. I'm Grady Cool, CEO of Cool Wealth Management. As a business owner, taxes can eat up more than a third of your income if you're not careful. Thankfully, it is ridiculous how many different ways you can save on taxes as a business owner, but there are some that count a whole lot more than others. Today, I'm going to be sharing my top 8 tips I use with clients every day to save the most on taxes. The most obvious place to start is expensing regular business activities. Generally, we're trying to make as little profit on paper so that we pay as little in taxes as possible. This includes regular business activities such as rent, office supplies, or any sort of things you use within your regular day-to-day activities. There are specific rules around some of the biggest items, so let's go over some of the most impactful ones. A home office can be a great way to expense part of your personal rent. When I say rent, that actually includes rent, mortgage if you own the place, maintenance fees, HOA fees, insurance, cleaning services, meaning all sorts of stuff. However, I do want to specify that it does not include depreciation. We'll get into that later in the video. You can only deduct a portion of each of these relative to the size of your office relative to the size of your home. The maximum size allowed for your office is 300 square feet and $5 per square foot. But that leaves a lot of space for a big office. The IRS specifies that the area has to be used exclusively for office usage. I can understand why that sounds a little bit impractical. Let's get more specific to take a look at what that actually means in reality. If you have a completely separate room, that's like perfect optimal situation, but you can also take part of a room and make it obviously sectioned off as part of an office. For example, I have a client who has a pretty big bedroom, meaning it's not a football field, but he took half the room and made it very clearly an office, and that works as his home office. Works great. Another big spending item is vehicles. You can deduct vehicle expenses that are used for business, which might include more than you think. Although you do need to keep a log of the miles that you drive specifically for business. It sounds like a lot, but there are apps that can really help with making this easier for you. Personally, I already have QuickBooks, so I just use their built-in app function to do it for me. The deduction does not include you
blasting Miley Cyrus as you're commuting to and from work.
Going to clients and meetings like that does count, but commuting to and from, not so much. Now, there are 2 ways you can do the deduction. The first and easiest option is a standard mileage rate set by the IRS, which in 2025 is 70 cents per mile. You take business miles, you multiply it by 0.7, boom, you got your deduction. The other option is to track actual expenses and then just take whatever the percentage of your business miles is and apply it to those expenses. Now, this can get you a higher deduction, but it is a big pain in the butt. However, it does include not just your gas, there's maintenance, insurance, lease payments, pretty much anything tied to your vehicle can be wrapped up in actual expenses, and then it'll be just a portion of those. All of that being said, there are times where it just doesn't actually save you enough money that the standard mileage is not just the way to go. You can even deduct expenses for traveling out of state or even internationally. This includes airfare, train tickets, 50% of meals, tips, and all sorts of other little things while you're traveling. To qualify, more than 50% of your days on the trip need to be used for business purposes, or 75% if you're traveling internationally. Thankfully, travel days count as work days. Weekend and holidays scheduled between meeting days or work days also count. For example, if you have work on Friday and on Monday, and you're stuck there on both days and there wasn't some reasonable alternative to be able to come back home and then fly back out, then those count as work days. The IRS doesn't give a really good definition of what counts as a work day, so use your own discretion, but generally speaking, at least 4 hours of some sort of work and something relevant to that location keeps you safe. Now here's the real fun part. Since you're the boss, you have a lot of freedom to determine what exactly you need to do for work. For example, if you have a client somewhere that you'd like to travel, as long as you can fit within the guidelines, then you can have a way to help deduct some of your expenses. If there's a convention related to something in your field and you go spend some time there, again, can help deduct some of the expenses of traveling. There are a lot of creative ways to make a trip related to business if you just plan ahead. There are a lot of rules around this area, so be careful and double check everything and keep good records. Here's another fun one: technology expenses. Phones, computers, TV, subscriptions, etc. These items are so cheap relative to a massive conglomeration like Walmart or McDonald's that you can expense all of them immediately, assuming you're not buying the highest top end possible out there. If it's over $2,500, you will have to depreciate it and then capitalize it over time, but again, that'll be at the end of the video. Now, you can only deduct expenses for the portion of it that is used for business, and there has to be a clear business use. Business use can be as simple as being on call, being ready to take a phone call while working at home, or with something like a computer, you use something like a Zoom call on your computer. TVs can be a little bit touchy, but for example, I have a TV I use for conferences in my conference room. Frequently works great for, again, business purposes. Assuming you don't want to work forever, then retirement plans can be a great way to save on taxes once net income for the business has been decided and you're figuring out how much taxes you personally actually need to pay. Money that goes into a pre-tax retirement account like a 401k or a traditional IRA, that's money that can be deducted from your income that you would generally be paying income taxes on. You do have to pay income taxes when it comes out in retirement, but you do get to avoid capital gains and avoid things like interest payments being added to your overall income for the year while it's growing over time. And theoretically, your retirement income should be a little bit lower than when you're actively working. The nice part as a business owner is that you get to contribute not just as the employee, but also as the employer, so the amount you can put into these accounts
is much bigger.
If you're a one-man show, then it makes it a lot easier with something like a solo 401k or a SEP IRA. Otherwise, with employees, there are still plenty of great options, but the compliance does get a little bit more complicated, and you usually do need to help pay for somebody to help you with some of the paperwork involved. But as the employer, you're still generally able to do a lot of neat things to increase how much you can contribute to the plan. Additionally, if your tax bracket isn't too high yet, then you can also include Roth options, meaning put money that you've already paid taxes on into the plan, but then when you take it out, there are no taxes involved. The S corporation election can help you save tons on self-employment taxes, which includes things like Social Security and Medicare. There are a lot of compliance rules here, so I'm going to keep things relatively high level. Instead of just being a standard LLC, you can choose to file as a S corporation. You have to pay yourself a reasonable salary, which is set relative to how much you work and what someone in your industry could relatively expect, and you will still pay self-employment taxes on that portion of what you take home. Then, everything else you earn can be distributed as distributions, which you don't have to pay the self-employment taxes on. This is under the assumption that you're the only owner of the S corporation. Gets a little bit trickier if you have multiple investors. The one big downside to this approach is that you can't use those distributions as income to then put into something like a retirement account. So if you're not already maxing out the tax bracket, then you sometimes end up with some of these trade-offs where looking at software to be able to figure out what exactly is going to be the best way to go based on what you're relatively estimating as income can help. Really depends on your situation. One other thing to consider is that setting up an S corporation can cost anywhere from $500 to $2,500. So this only really makes sense if you're actually starting to make some decent income from your business. Well, there are tons of other deductions that I could cover. I want to keep things concise today, and the last thing I want to cover is depreciation. When you purchase an expensive asset, such as a toy machinery maker, then you have to capitalize it and then depreciate it over time. More specifically, if it costs more than $2,500 and it's going to be used over multiple years, then you capitalize it, meaning put it on your asset sheet, and then you're going to depreciate it year by year. For example, if I had that toy machine, if it was $10,000 and it was going to work for 10 years, then I would depreciate it by $1,000 per year, assuming that at the end I'm just going to be throwing it away. There are other ways to record depreciation, but we'll save that for another video. The big takeaway here is that there are multiple ways to deduct expenses on all sorts of different purchases, not just the little ones. Saving money on taxes can make all of the hard work feel a little bit more worth it. I hope you guys learned something, and I will see you in the next one. Bye.